While we all work towards a new normal in the current environment, working, meeting, and learning virtually has become an even more valuable tool. We're pleased to announce our 2020 webinar series and look forward to seeing you each month. This year's webinar series will focus on the whys of insurance. LLIS offers many insurance solutions for fee-only financial advisors and their clients. We understand that with many options come many questions, which is why in 2020 we'll tackle the whys of insurance. Each webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions by asking, or excuse me, as you have them by typing them in the questions box. We'll answer all questions at the end of the presentation. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2020, fee-only financial advisors have the opportunity to earn 9 CFP CE credits, one for each month. Today's presenter was recruited from one of the top disability insurance providers to be our second disability insurance specialist. Since 2015, he's helped many advisors and their clients with not just disability insurance, but also life insurance. Here to explain why it's important to protect your client's income with disability insurance is Brian Ciccarelli.
Thank you, Claudia. Welcome, everybody, and thanks for logging in to talk about disability insurance today. As Claudia mentioned, today's topic, why protect your income with disability insurance. Let's get started. So first, why disability insurance? We'll talk about some of the odds of becoming disabled and why it's important to have coverage. We're going to talk about occupational classes. This has a big determination on what your clients are going to pay from a premium perspective. We're going to talk about policy design, what goes into a disability policy from base benefits to policy riders, as well as underwriting. Claudia mentioned in the COVID-19 world that we're living in now, underwriting's changing. And we're going to talk a little bit about the current underwriting in the COVID times. And also we're going to talk about a little bit about claims experience and some claims that we've seen over the years. But why disability insurance? What are the odds? Well, let's talk about low odds. Getting a shark attack, getting attacked by a shark, 1 in 3.7 million. Although living in Florida, being at the beach this weekend, I got to tell you, I thought about it. How about getting struck by lightning? We're actually, Tampa Bay is the lightning capital of the world, so your chance of getting struck by lightning, 1 in 1.2 million. How about winning the lottery? Yes, it happens. I know someone who did win the lottery, but it wasn't me. So right now, there are very low odds that any one of the three of these will happen to me. But what are some of the higher odds? What are some things that can happen more frequently? Maybe experience a disability during the working years. So the average professional during their working years will miss work 90 days or more due to an injury or illness. The average duration of a long-term disability is 2.5 years. But however, we also want to protect for our clients' long-term goals, and it is common that a client could go out on disability claim till their retirement years, and we can help cover that. What about the cause of a disability? 90% of disabilities are illness. Well, if you ask somebody about, about becoming disabled, most people say, I'm good. I have disability insurance. We have workman's comp at work. And yeah, that's great if the injury occurs at work. And then what about freak accidents? Your clients are logging in TV, or you can just log in to watch the nightly news. And it's oftentimes you will see an accident happen. So that's a common thought that someone might have. So yeah, maybe I can become disabled if I'm in an accident. But it's not the injuries at work or the freak accidents that we see most of the time. The long-term disabilities are generally cancer, heart attack, diabetes, back pain, arthritis, and even mental nervous. These are things that we can't see ahead of time, in planning for them. Sometimes things just happen, and it's not sudden. What does disability insurance do? Well, one, it creates a safety net. It also replaces a paycheck, and it creates peace of mind. I have my wife will every so often, every so many years, she'll ask me, say, "How much are we paying for that disability insurance?" And I got to remind her she has a coworker that her husband was injured, and he is no longer working and has been working for years. And his injury led to other issues as well, such as mental nervous condition. They have a exorbitant amount of medical bills that they're responsible for, and at the end of the day, their current lifestyle, their working lifestyle, as she's working, is not what they planned for. And then the retirement years are not going to be what they were because her husband didn't have disability insurance. So once I remind my wife of that, she understands why we're doing it, and we continue to pay the premiums. So when is the best time to buy disability insurance? This is a question I get often. Well, the short answer is when the client needs the protection. Oftentimes it's better to purchase a disability policy in the younger years where they can pay lower premiums than wait 10 or 15 years to purchase a policy where they're going to be paying higher premiums. In addition to that, if a client purchases at age 25 and they go out on disability at age 26, they could potentially pay up to about 40 years of benefits. So it's better to lock it in the younger you are. So what is the cost? That's often an objection to disability insurance. I'm sure you've heard it all the time. So the cost of income protection, think about a lunch day out. You could easily spend 15, $20 on lunch, daily coffees, 50 to 100 plus if it's a name brand coffee. Date nights, I have $80 here, but I have two young kids, and just for my wife and I to walk out of the door, we got to pay a babysitter, and that's not cheap these days. So income protection. What do we pay for income protection? Well, you can plan usually generally about 1 to 3% of your client's salary will go to income protection, and that could vary. It could be more than that, depending on male versus female, age, and occupational class. And we'll go into more details regarding occupational class. And so if you see on this slide here, there's many different occupations. I see two chefs in the middle of the page. Think about a chef. They're using knives. They're using fire and stoves and hot equipment. Could be slippery in the kitchen, easily fall or get cut, or something that can cause an injury. So their rates are going to be higher because their risk due to their occupation is higher, and there's a greater chance that they would lead to claim. So the cost per thousand for a chef is going to be higher than, let's say, someone sitting next to them, the CPA. CPA who's sitting at a desk all day, working on taxes. Yeah, there's probably low risk there. The claims experience will say that are lower risk. There's less claims for a CPA than a chef. Well, all that will determine what your clients will pay. So let's start off here in the occupational classes that we see. So occupational class B, a mechanic working, with tools, working with hot things, easier chance for them to get an injury than someone who's, let's say, an engineer. Occupational class A, next class up, plumber, cashier, caterer, 2A, medical lab tech, receptionist. And then you get into 3A, 4A, and 5A. And I've highlighted financial advisor here because a financial advisor could fall into one of these three categories. So your base financial advisor, someone who's new into the industry, less than 2 years experience, less than $75,000 per year, um, no designation, no CFP or CLU. You can expect to have a 3A occupational class. Uh, then you move up to 4A. 4A is going to be a lot of your white collar professionals are going to fall into the 4A category. This is a financial advisor who has, is making more than $75,000 a year, a few years of experience would fall into this category. And then you move on to 5A. These are usually your CEOs, your senior level professionals, a financial advisor who has several years of experience, CFP, CLU designation, making $150,000 a year, could fall into the 5A category. And then we're also looking at 6A. Not all companies offer 6 occupational class, but it's important that when it comes across and it's available, we look for it. And these are going to be our attorneys, are CPAs, not an accountant, but a accountant that is a CPA would fall into the 6A category. These are scientists with PhDs or engineers with a professional engineer degree or designation, a PE designation. So anytime that you send your clients to us and they do have specified designations, make sure that they highlight it to us. And anytime that we can get them a better occupational class, we're always going to reach for it. So the cost per benefit, once again, the highest cost is going to be on the left for your mechanics, your bartenders, and your lowest cost per thousand is going to be with your 6A and 5A occupational classes. In addition to the A's or 2 through 6 or 2A through 6A, we'll often see many medical or occupational classes as well. You might see a 4M for 4 medical or 4D for 4 dentist, 4S for 4 surgeon. So each individual company may have a different term, but they all kind of run the same. So let's look at what an occupational class and how it would determine premiums. Here's Richard. He's age 35. He qualifies for a $5,000 monthly benefit, which tells me his income is about $100,000 here. If he was in a 3A occupational class, he can expect premiums of $2,630. 4A increased by about $300. In a 5A occupational class, if he's applying for this coverage, he would pay about $600 less than the 3A. So his premiums would be $2,040 per year. And this is similar since financial advisors fall in all three of these categories. You can see how the different level of financial advisor would be assessed with a different premium. Now, let's flip it over to Melissa. Same situation, same income, same monthly benefit, same age 35. As you see here, as a 3A, she would pay premiums of $46.87. That's a significant increase over Richard. And why is that? Well, the reason being is that it all comes down to claims experience. In life insurance, men, we pay higher premiums because we have a lower life expectancy. So we are more risk to the insurance company, meaning that there's a higher chance that they'll pay out a claim on a male versus a female. Well, also age 35, you can anticipate paying rates of almost 70 some percent higher for a female, where the claims experience in the birthing years are much higher for women, so they pay a higher premium. But moving on to 4A, you can see there's a $600 difference, and then 5A, there's a significant difference, about $1,200 difference between an all class 3A and 5A. So the occupational class really determines what your clients can anticipate paying. So building a policy. So there's a lot of different things that go into a disability policy. That's a great thing because we can design or tailor to your specific or your client specific needs and or wants. And let's walk through those options. First, we start off with a base monthly benefit. This is the amount of benefits that they would qualify for based on their income. And if they did have a current individual disability policy or a group disability policy in force, that would deduct from the base monthly benefit amount. So, for example, when we looked at the previous example with Richard, $100,000 income, no current disability coverage at all, he qualified for a full $5,000 monthly benefit. However, if he did have a 60% employer paid group policy in force already, and he's going to apply for a supplemental coverage above that, he would probably qualify in a range of, maybe $1,500 to $2,000 of additional monthly benefits. So the base monthly benefit is dependent on income and also any current coverage. Then we look at the benefit period. This is the time from how long your clients will receive benefits. Most of the quotes that we run in the fee-only advisors are looking for is to the retirement years. So most of ours are to age 65. Some advisors say their clients are working longer. They'd rather see their income protected to age 67 or age 70, and we'll run those quotes as well. And also there's options for a 10-year benefit period, a 5-year or a 2-year benefit period. The lower the benefit period, the lower the premiums. Once again, less risk to the insurance company. The higher the benefit period, the higher the premiums. And then we have elimination period. This is kind of your deductible period. So this is from the time of onset of injury or illness until you can start accruing a claim. So for example, most of the quotes that we run are 90-day elimination period. So if I had an accident and I was injured and I couldn't go to work, I'm starting losing my money, and it happened on January 1st, I would have to wait 3 months before I could start accruing the claim. Doesn't mean I should wait 3 months to file the claim. I should file the claim at the time of injury so they can get the paperwork started. However, I'm going to have to wait 90 days of self insuring, so to speak. For the advisors out there that have their clients who are in a good spot and would rather self insure a little bit longer, maybe 180 days or 6 months, and have the cash on reserves that they can pull from in order to self insure longer, can be rewarded with lower premiums. The higher the elimination period, the less risk, the lower the premiums your clients will pay. And then the most common riders that we'll underwrite with are own occupation, residual disability, cost of living adjustment, catastrophic benefits, and also future increase options. Now let's look at an example of how a policy would be set up. Here's Charles. He's a professor, $100,000 base salary. He receives a $35,000 bonus. He's age 43. His current monthly gross income is $11,250. After taxes, his take home is 8438. Now, he does have an employer paid group benefit with a monthly maximum benefit of $5,000. So if he were to go out on claim, he'd collect that 5,000 minus any taxes because his employer paid the premiums, so that means it's taxable at the time of claim. So his 60% benefit on his salary is only netting him 3750 per month, much different than an 8438 take home that he has. So in this case, he qualified for a supplemental individual policy. We were able to get Charles an additional 4430 of monthly benefits in addition to the 3750. So we're able to get Charles 8180 of monthly benefits. That's not bad. That's about 97% of his current take home pay. Now, we won't see more than that because the insurance companies do not want to incentivize a client to stay home on the couch recovering and de-incentivize them from going back into the office if they had more than 100% of their pre-disability income. So let's look at optional riders. And the first one was the own occupation rider we talked about. Now, own occupation is something that a lot of fielding advisors are looking for. A lot of our professional clients want own occupation. And basically, own occupation is saying that if you can't do your duty, let's say you're a physician, you can't do your duty as a physician, you can get full monthly benefits from your disability policy. And if you choose to, not forced to, but if you choose to work in another occupation, and for physicians, a lot of them want to teach medicine or do something similar. And let's just say, for example, they can make $75,000 a year just teaching medicine. Well, with own occupation language, it's saying you receive your full $15,000 monthly benefit and the full $75,000 that you would receive from teaching. If the policy did not have the own occupation language and the physician decided to teach while being disabled in his occupation, any monies that he would make teaching would offset the benefit from the individual disability policy. So, own occupation is a much richer definition, and most professionals we work with are seeking that. Future increase option is another one. This is a great option to have. As your client's income increases, future increase option allows them to purchase additional monthly benefits as their income grows. And the beauty behind it is there's no medical underwriting, only financial underwriting. So the insured is medically underwritten for future increase options at the time of initial application. So the client's perfectly healthy, no known medical issues. If they have any medical issues in the future increase option can still be purchased with no medical underwriting, so they can hold it against them. So, for example, if your client purchased the policy and put it in force 6 months ago, and today they develop melanoma on their skin, well, the insurance company can't hold that against them. So when it's time to look at their future increase option, they can still receive future increase option with no medical um, issues there. So you'd be underwritten without any melanoma exclusion, so to speak. So great option to have. Residual disability. This is probably my favorite benefit on or rider on a policy. And I say that because you only need as little as 15 or 20% loss of income in order to file a claim due to injury or illness. Without this option, you would need to lose at least 80% of your income before you're eligible for a claim. And let's talk about a residual disability. So, let's say that your client is skiing in Colorado. They take a pretty good fall. They might break a hip or shoulder or leg, and it's really going to limit or impact their income because they can't do their job at 100% capacity. As long as they're losing at least 15 or 20% of their income, they're eligible to file a claim for a residual disability or a partial disability benefit. This would also work on the back end of a disability. So, for example, your client's out for 2 years on a cancer claim, um, and they're able to go back to work, but maybe not at 100% capacity. So they start back to work, and maybe they're working half the time, making 50% of their pre disability income. Well, as long as they're still losing at least 15 or 20%, they'll receive a partial residual monthly benefit. Great rider to have. Cost of living adjustment. Now, this one is sometimes confused with future increase option. Remember, with future increase option, this is a this this will allow your client to keep up with their income while they're still working. Cost of living adjustment keeps up with living adjustments after being on claim at least 1 year. Once you're on claim, you cannot apply for a future increase option. After being on claim for 1 year, usually about 3% will be added to the monthly benefit each year after being on claim. So keeping up with the cost of living. And then there's catastrophic disability benefits. So this is think of your worst case scenario of a disability, or what I like to call long-term care for the working years. So someone who has a cognitive injury is going to need a lot of nursing care, or they're going to have a lot of medical bills. Someone who loses eyesight, hearing, maybe two limbs, can't perform two of the six daily activities of living, would qualify for a catastrophic disability benefit. Now, this is an additional monthly benefit on top of the traditional base monthly benefit. And the catastrophic recently changed with one company as well, or added some additional benefits. So we have one company now that will go up to $12,500 in additional monthly benefits uh, if the client chooses to accept it. But at first, I'm thinking about it. I'm saying, well, why would somebody really need $12,500 of additional monthly benefits? Well, then we got to talking about it and said, well, maybe someone might want it if they have a strong family history of heart disease or high blood pressure or stroke. And maybe they have a more advanced chance of becoming catastrophically disabled. Another good example is early onset of Alzheimer's or dementia. So these might be some of the candidates who may want to purchase those additional benefits in order to cover the risk. So here's Kevin. He's age 33. He's a physician, an ER physician. He has a base salary of $260,000. He makes a bonus of $1,500. He does have a 60% employer paid group policy. His maximum monthly benefit is $6,000. So he qualified for an additional $8,250 on top of his existing group. And he chose a 180-day elimination period, benefits age 65, all the great riders we just talked about. And his annual premium, he can expect to pay about $36.75. Here's Karen, who's age 40. She's a VP in marketing, 5A occupational class. She has a $119,000 salary. She has no current individual or group coverages. She qualified for a monthly benefit of $59.10. Benefit period age 65, 90-day elimination period, all the great riders, and her annual premium was $39.32. Government employee. This is very important to note. We do see quite a few government employees. that we work with that we quote out as well. And it's important to understand that anytime you have a government employee, whether it's local, state, or federal, most of them, a majority of them, have some type of PERS, SERS, or other retirement benefit package that they pay into. And this package, which some advisors don't know and most of the clients don't know, has a long-term disability benefit built into it. So all companies we work with would consider a 40% group benefit for anybody who's a federal government employee. State and local, they're going to automatically put in a 60% group benefit. It doesn't matter if it's 67% or the actual is 35 or 45. They're going to use the numbers 40 and 60%. Well, and that's standard across the board, but what about those individuals who are local, state, or federal employees, but they truly do not have a group disability benefit through a retirement package? Well, most of the companies we work with will say, regardless of what they have, they're going to get discounted 40 or 60%. Well, we do have some cases where they are government employees and we can prove that they do not have a group disability benefit through a retirement package. We have to get proof from their HR department, submit it with the application. And we do have one company that will consider the full monthly benefit they're eligible for and not discount the 40 or 60%. And this is how it would look. So here we have a state employee, $80,000 income. Well, the monthly benefit with Guardian, they would look at this as um, non-taxable 60% benefit from their employer. So Guardian says, well, they qualify for an additional $570 of monthly benefits. Standard would look at it and say, we'll consider that they have 60% taxable disability benefits through their employer, and so they would receive an addition. They would receive a benefit of 1665. In principle, if we can prove that the government employee truly does not have that group benefit, then they'll qualify for the full $4,000 that they're eligible for and not discounted at all. So there's a huge difference here in what they would qualify for depending on the company. So it's important that when we do see government employees, we research and find out more about uh, their retirement disability benefit. But in addition to the monthly benefit, the future increase option is different as well. So Guardian we can only limit it up to $1,140 of future increase options, while both standard and principal will allow the maximum they're eligible for um, based on their income. Multi-life cases, these are great. So multi-life case means that there's three or more applications from one company submitted, and there's several benefits to having a multi-life case. So one company that we work with will offer a 20% discount on their annual premiums. So we just went over all the premiums of different clientele and different occupational classes, and you can see 20% is a huge discount if there are three or more applications from one company. In addition to the 20%, they can choose to have an additional 10% reduction if they limit the mental nervous benefit period to 24 months. So they would qualify to age 65 traditionally for mental nervous. But if they want an additional 10%, they'll limit it to 24 months. And now they're getting 30% discount. But wait, there's more. They also offer gender neutral rates for these cases. So gender neutral is great for females because we looked at earlier the examples of the 3A to 5A occupational class, and we looked at male versus female rates and how different they were. Well, the gender neutral rate is in between a female and a male rate. So the females automatically start at a lower rate with a gender neutral rate in addition to the 20% and 10% additional discounts. So big win. So think about your clients who are business owners and they have a few employees at their location. They'd be a great candidate for multi-life cases. Or if you're working with someone from a specific firm or company and they all have applications together, we're able to get a multi-life discount. Huge win. New professional program. This is a great program designed for new professionals in certain occupations: veterinarians, doctors, CPAs, engineers, physicians. And this is students, residents, and first year professionals. The advantage to applying as a new professional in the new professional program is they don't consider group insurance. So regardless of any group insurance you have, discount it they don't discount the group insurance. So they don't even consider it. Income doesn't matter. As a student making zero or a resident making $60,000 a year, they're going to qualify for a higher monthly benefit than their current income would allow them for, and they can choose a graded premium option. Now, a graded premium option, the way it works is that they start off with a lower premium, and every year that premium steps up a little bit. So each year that they can expect a premium increase in their policy. However, it's a savings of about 40% with a graded premium compared to a level premium for all years. Most of the policies that we have going out are level premiums. But think about it, if you're a resident and you're making, $40 to $60,000 a year, taking on an additional expense financially, they're probably not on their feet yet. So taking out that additional expense, if you can pay a premium that's 60% with of a level premium, it might be advantageous to do that. A lot of times, maybe 3, 4, 5 years down the road, once they're established in their career and financially getting on their feet, most of these professionals will convert their graded premium policy into a level premium policy. So usually that's done within the first couple of years, or they can keep it for all years as well. But so what does that mean? So special issue limits. OBGYN would qualify anywhere between $6,500 and $7,500. Other medical specialties as well. An engineer can qualify for an automatic benefit of $1,500 to $4,000. Pharmacists between $2,000 and $4,000. The available riders: own occupation, residual, cost of living adjustment, catastrophic benefits. Future increase options up to $12,000. So what does that mean for some of the new professionals will qualify for future increase options of 12,000 above and beyond the standard base benefit. And this will lock them up to their maybe first $300,000 of income between the base benefit and the future increase option. It really sets them up for the future. And we also have now allowing increases within the first year once the new professional launches. And what that means is that, let's say your client applies in January with a new professional program, and then they launch in September or over the summer. They're able to do an advanced future increase option once they launch into the new career with their new income. So they're allowing advanced future increase options now, which is a great thing. Here's a case study for Jessica. She's age 40. She's a resident physician. Her annual salary right now is $70,000. She qualified for a $5,000 monthly benefit. All the great riders, premium of $2,630. She qualified for gender neutral rates and a 20 to 30% discount. However, she chose it. That's a pretty good discount. Then there's student loans. A lot of the professionals we work with do have student loans, and they want to protect them, and we have a solution for that as well. Student loan protection rider will protect undergraduate and graduate degrees. The loans have to be government or bank-backed loans. They can't be Uncle Louie. They reimburses between $500 and $2,000, $1,000 to $2,000 for students pursuing or holding advanced degrees, 1,000 or less for all others. The duration is either 10 or 15-year duration period. Elimination period is 90 or 180 days. The premium is only a level premium for this option, no graded premium options here. And it's a reimbursement policy, so your client would actually have to make the premium payment, and then they would get reimbursed for it. So here's an example of student loan. Paul, age 44. He's a cardiologist making $775,000 a year, doing very well. He came to us. He had an individual policy of 16,165 of monthly benefits. We were able to get him an additional 7335, and he also applied for a $1,500 student loan rider for 10 years. That student loan rider was only $308 per year to protect his student loans. Retirement party. Everybody's excited. Fee only advisors do such a great job of preparing your clients for retirement. You want to make sure when they get there they're well prepared, and you want to make sure that a disability doesn't detour that plan. So we also have a retirement option as well. Here's Brianna. She's age 44. She's an attorney. She had a base policy benefit. Annual premium was 39.63. In addition to her base policy, she applied for a retirement protection plan option where she was able to get an additional $2,800 of monthly benefits, future increase option, cost of living adjustments for the retirement plan in addition to the base benefit. And that premium to have her retirement protected was only $13.19 per year for that rider. Now, it's important to understand that when we look at this base policy benefit, she qualified for 5480. If she goes on disability, full disability, she will collect a full 5480 to age 65, and that goes directly to her bank account. Now, for the retirement program, doesn't go directly to her; it goes into a trust, so that when she becomes retirement age, at age 65, when her base policy benefit drops off, she can now access that trust, which will allow her income for her retirement years. And think about it: when she's on disability, chances are um, she's not contributing to a retirement fund on disability benefits, and her employer is also not contributing any benefits. So while the disability policy protects her during the working years, the retirement protection plan is going to protect her retirement income and plans in the future. And here's another case study. Here's Mark. He's age 32. He's a CPA and a business owner of a CPA. He got a monthly benefit of 7175. All the great riders. His base policy was 2036. He qualified for a $1,500 monthly benefit for retirement, and that benefit was only 373. So very affordable for Mark to add this benefit and this protection onto his policy. Underwriting. So we look at underwriting now, and COVID-19 underwriting guidelines are much different. The good news is that a lot of them are looking at uh, benefits that are easier for the clients. So a lot of them are, for example, Principal is now writing up to a $10,000 monthly benefit with lab-free potential. What does that mean? What that means is we're going to submit the application to Principal. They're also going to do a telephone interview with the client. Based on the application and the interview with the client, they're going to determine whether the labs are going to be needed or not. So chances are they're not going to even need to use the labs at all, so they can go lab free. And why is this important? Due to social distancing in the COVID world today, a lot of clients just simply do not want somebody coming into their home. So this is a huge benefit that they're allowing clients to, as an option, possible to go lab free. And standards the same way, $10,000. And Guardian now is suspending labs. They're trying to use the medical records on all amounts, which is a huge advantage. Guardian is also sweetening their underwriting as well, offering up to $30,000 of monthly benefits, which is much greater than they would do in a non-COVID world. They're also looking at future increase options, allowing clients to take early advance future increase options. So if you have any clients that have a Guardian policy and they're looking to take an advance or looking for a higher monthly benefit, now's a great time to look into that. Financials. When it comes to financials, a W-2 employee traditionally need like their pay stubs or W-2. If they're a business owner, they need business tax returns. Usually, you're going to have to submit. And if you're a consultant, a lot of times they'll want to see contracts. How far out do you have contracts for? They want to look at that consistency. Um, while they focus on medical underwriting, it's also heavily focused on the financials. They want to make sure that what they're underwriting you for, that you qualify for, and you have a track record and the consistency with that specific income. What about underwriting from a medical side? Uh, Life insurance and disability insurance underwriting is different. There are things that you can obtain a life insurance disability or life insurance policy and not a disability policy. So life insurance is looking for mortality. What's going to kill the individual versus morbidity with disability? What's going to cause someone to go into claim for disability? They're usually looking for comorbidity, meaning you have heart disease and you have diabetes, or you have two things that may lead to additional reasons to go out on claim. So what they look for in life insurance is somewhat different than disability insurance. Smoking. This has been one of the biggest topics I would say in the past year, and marijuana. So marijuana has changed drastically over the last year. A lot of states have legalized marijuana, and a lot of clients are now talking about it and saying that they do use marijuana. So for disability insurance, it's all about the frequency. If they're doing it once a week or less, we can get non-tobacco rates with just about all the different disability companies. If they're using marijuana more than once a week, we can expect anywhere from tobacco rates to a decline. Decline's usually going to come when they're almost doing it daily, or they're using marijuana daily. Yeah, we can expect a decline with all the different companies. But it all comes down to the frequency. And it doesn't matter how they use it or how they absorb it. There's many different ways to do it now. All the underwriting is the same. The good news is that if they do get a tobacco rate with usage of more than once a week, it's about 25 to 30% higher than non-tobacco. When we compare that to life insurance rates, that's about life insurance rates are about 200 to 250% higher for tobacco users than non-tobacco users. So the increase is definitely there, but not quite the same as life insurance. What about exclusions? We often see exclusions. Anytime we see a client that has any pre-existing medical conditions, um, that we can almost anticipate an exclusion. Mental nervous is probably one of the biggest ones that we see. Anxiety, depression, substance abuse, any medications within the past 2 years or treatments. We're expected to have a mental nervous exclusion, which means that if they go out on claim due to anxiety, depression, substance abuse, or one of those combinations, it would not pay a claim. And then in addition to not paying a mental nervous claim, they will limit all benefits to 5 years, and some riders may be removed. Oftentimes, we'll see future increase option not available when there's a mental nervous exclusion. Also, back exclusion is one of the biggest ones that we see. A lot of your clients to see chiropractors, we can almost always anticipate having a back exclusion on their policy. And the policies or the exclusions are usually considered permanent, meaning they'll never remove that from the policy, or they're reconsiderable. Um, so, for example, someone who's had back pain maybe 18 months ago and they haven't seen a doctor since, no treatments or no symptoms. The insurance company say in a 1 year anniversary of their policy, they're willing to reconsider that back exclusion, providing the client doesn't have any symptoms or have any treatment in the past year. Well, at LLIS, our policyholder services team, we follow up with the clients. We'll put a note in the system to reach out to that client in 1 year or 2 years or 3 years, whatever the reconsideration period is. And we'll follow up and ask, are you still having back issues, or have you seen anybody in the past 2 years? And as long as they haven't had any symptoms, we'll go to bat for them and we'll reach out to the insurance company and request to have that removed. Generally, that involves looking at their medical records. But we've been very successful with removing exclusion, which is a really great thing for the clients. And claims experience. Here's some examples of some claims. We have a dentist here, carpal tunnel, $1.3 million in benefits paid over 126 months period. We also have a physician's assistant who's age 25, 6 years later went on claim due to a broken pelvis, received $45,000 in benefits over a 16 month period. But if you scroll across this slide, you can see there's many reasons here that, or many conditions that clients have gone out on claim that you would never plan for. You would never think that you would have it. And so these are some good examples of different age groups, from young. I see, was it 32 to age 60s, where they're having a disability and a benefit being paid. So claims experience, we have one company that has a 97 percentile claimant satisfaction score, which is very high. Paying benefits promptly, they got a 99%, and also paying benefits accurately, which is always good, is 98%. So we've had good feedback with claims experience with the companies that we use. Um, in addition, we talked a little bit about disability insurance for group versus individual. There's many differences. Not all disability policies are created equal. For group insurance, oftentimes it's a 60% base salary benefit. They usually don't cover bonus or commissions. So if your client has bonuses or commissions, chances are it's not going to cover that. However, there are some executive style policies out there that will cover bonuses and commission. We have to look at that. Whereas individual policy, we can apply for the maximum benefits available and even also cover the bonus or commissions. Taxation of the policies, if it's an employer paid group benefit, your clients are going to be taxed on the claim monthly benefits, whereas individual policies are paid with after tax dollars, meaning that they arrive tax free. Disability definition. So we talked a little bit about own occupation earlier. With own occupation, we're protecting the client's occupation, the full monthly benefit, plus if they choose to work in another occupation, that's all on top of the monthly benefits. Most group disability policies will have an any occupational language, meaning that if they can't do their duties as a physician, but they can answer telephones or do anything else for that matter, they're going to be required to get another job. Or I've even seen some group policies that I reviewed that it can be reasonably trained to do. You're going to be forced to be trained to do another job, and if you don't do it, then you're not going to receive benefits. But if you do go into another occupation, any monies that you make in the new occupation would offset the group monthly benefit. So, big difference there. Elimination period, usually have one elimination period option with group. Individual, we can choose anywhere from 30 days to 1 year. Non-cancelable, guaranteed renewable. Group policies are not guaranteed. They can be canceled at any time by the insurer or the company that is using that policy. They can cancel that. Individual policies, most of the policies that we're underwriting are both non-cancelable, guaranteed renewable, meaning that they cannot be canceled and the premiums are guaranteed for the life of the policy. Rider options, many options available with individual, very limited when it comes to group benefits. Convertible, typically you can convert. Sometimes you can convert a group policy, but not always. Once you leave your employer, sometimes your policy is left behind. Sometimes they offer portability, allow you to purchase it at higher rates. With the individual policy, you get to keep that regardless if you change your occupation, do something different, and go out and start your own business. You're able to keep the occupational class and the benefits that you applied for in the beginning. Now, there's a printout too. You can go on llis.com, go under Advisor Tools, and you can print this out. And this is a nice comparison to talk about when you're talking with your clients. But we don't expect you to remember all of these nuances about the two. If you ever have a client, you're looking at a policy, give us a call. Call Kathy or I, and we're happy to answer any questions. Drop us an email, and we're always happy to answer any questions you may have. Disability policy review. Oftentimes you'll get a policy from your clients, and sometimes you'll understand it, sometimes you may not understand how it works. We're happy to review them. Please send the policy over to us. If you have any health information, any current benefits other than that policy they may have, and also their income. We'll be happy to review it, see if they're eligible for anything different. I would say most of the time that we receive policy reviews, I'm telling the advisors to make sure the client keeps what they have, because if we're trying to replace a policy that's 5 or 10 years old, chances are we're going to pay a much higher premium today while applying than their current premium rate. So most of the time we're going to say keep the policy they have. When there are some times where it is valuable to replace a policy, that might be a time where your client maybe had a 5 year benefit period. They had a mental, nervous, or anxiety when they originally took out the policy. They no longer experience it. We can maybe apply for benefits to age 65, which would be a huge benefit. Or it may not have had own occupation, their existing policy, and it might make sense to have that own occupation language. If we can better a policy, then it's good to replace it. But other than that, most of the time we're going to keep it and maybe build on to that current policy. So, top 10 things that make LLIs different. Number one is free monthly webinars. Stay tuned. In June, we're going to have another disability conversation, why protect your businesses with disability insurance. Two, we're not your competition. Our only clients are fee-only advisors. We save advisors time and your clients money. We pre-underwrite to avoid surprises. We provide many tools on LLIS.com. We proudly sponsor NAPFA, Garrett Planning Network, NAPFA Genesis, XY Planning Network, and ACP. We have specialists in life, disability, long-term care, annuities, and also hybrids. We also manage your clients' policies with both now and in the future with the advanced premium notices. We also, have you met Alice yet? Alice is a great online secure portal that you're able to log in and look at all your clients' quotes, all of their policy information, and a good way to communicate with us as well. Any questions?
Thank you, Brian. So yes, we did get a few questions while you were
Okay, great.
presenting. So the first one is, are current disability policies written to include disability for a pandemic? And will there be a new rider added for this?
Yeah, that's a fantastic question. We don't have any information of any of that changing at the current time. So, not to say that won't change in the future. I mean, we're still in the pandemic today, so we're not sure how long this is going to last or what the outcome will be. Just stay tuned. We'll be happy to see how that ends up. But the current day, we're not seeing any changes for that. In life insurance as well, we haven't seen any current changes. But over time that may change based on claims experience.
Great. The next one, if a corporate executive takes a severance package, either in, say, a 2-year payout or a lump sum payout, and now they are looking for work but are not employed, can they get long-term care? Can they get long-term disability insurance?
Yeah, that's a good question. They're only going to be able to get insurance if they're currently actively working. So if they're not working, they would not be able to get it. If they applied for the insurance before they knew that they were going out on the severance, then they would be able to have the insurance while they were still working, and then once they went out, as long as they continue to make their payments, they would be able to keep it.
Great. In marijuana use, is marijuana use considered in disability underwriting in states where it is legal?
It is. It's considered in all the states. They've really come a long way with the marijuana underwriting. So usually most of the companies, if the frequency is less than once a week, it's not going to be too much of a factor. It's really the biggest issue is when they're using it more than once a week or and daily we can anticipate a decline. So between more than once a week to every day, we're going to see a tobacco rate, a higher premium, or a decline.
Okay. And how much of a reduction in premium do you tend to see with longer elimination periods?
Yeah, that's a good question. I'm not sure that there's a specific percentage because it really depends on occupational class. It depends on the age of the client. I'm not really sure. If you're interested in looking at it, it's great if we can run it and kind of compare. For some folks, it might make a difference of 70 or $100 per year, and it's simply not worth it uh, to increase the elimination period. Where others, it could be a lot more significant, and the client is really looking for the lowest premium, really looking for this as a catastrophic event. They've got other income elsewhere, then it would definitely make sense to increase it. But as far as a percentage, I'm not sure that I can know that off the top of my head without running it.
Okay. If someone has basic group coverage through their employer, 60%, but the employer allows them to buy supplemental coverage, can you speak of the pros and cons of buying supplemental group disability versus a personal disability policy?
Sure, yeah. So usually it's a good idea to supplement regarding it, regardless of it's a group plan or an individual plan. And really, what it all comes down to is the verbiage in the contract and the actual language itself. I reviewed one today actually, and the supplemental plan offset for any group benefits. So in this case, the one I looked at today was a government employee. So since they're going to get that 40 or 60% through their retirement option, the supplemental policy offset that current policy. So in that sense, the supplemental policy, since it had the offset, the language wasn't as strong as an individual policy. The individual policy would have given them a full monthly benefit that they qualify for, regardless of the additional offsets of Social Security or retirement income, because the insurance company already planned with that being in mind. So traditionally, uh, individual policies have stronger language, but that doesn't mean that the group supplemental policy is not as strong. It all depends on what's in the contract specifically. So if you do have a supplemental group policy, send it over. We're happy to review it and let you know what it offers and talk about the pros and cons to the policy.
Great. Do union employees typically have group disability coverage?
So union employees will sometimes have the group policy or options available to them. If you do have it, send it over, and we're happy to review it. And happy to look at their options as well. But in general, I would assume that the associations do have something available to them. Not sure if each individual client is participating in it or not.
Perfect. Does an occupational therapist qualify for the new professionals program?
Good question. I'll have to get back to you on that specific occupation. I'm not sure. That's a good question. And Claudia, if you can write that down, I'll be happy to follow up on that.
Yeah, absolutely. And another question is, if someone has a private policy and loses their job and then becomes disabled, assuming the private policy stays in place and would pay out, mm, not sure if maybe I read that correctly.
No, no, I understand it.
Okay,
That's something that we get every so often. So yeah, so if they leave their current position or get unemployed, as long as they continue to pay for the benefit, then they would receive a benefit. Now here's how that works. If they have a full disability, let's say they're fully disabled, they cannot work, they can apply for the full monthly benefits eligible forms. Let's say it's a $5,000 monthly benefit contract. They can get the $5,000 a monthly benefits. Now, where that gets a little tricky is if it's a residual claim. So maybe they're not 100% disabled, maybe it's 50% disabled and they're unable to do 100% of work. They could apply for a residual benefit with the individual insurance company. However, they're going to look at either, depending on the company, it's either 12 or 24 months of past income and average what their income is. So, full disability, yes, they still file the claim. It's the residual or partial disability that gets a little um, complicated, but the insurance companies will walk them through that claims process. Good question.
And I think we have time for just one more. Do you see the catastrophic rider used often?
So it is used less often because most disabilities are not catastrophic. But the advantage here with the catastrophic disability benefit is that it's at a much lower premium. Once again, it's all based on risk. Since there's lower cases of catastrophic disabilities, they offer a lower premium for it. So you could look at that as two ways. And one, I'm probably never going to use it. Or two, if I use it, it was at an inexpensive premium. I'm sure glad I have it.
Awesome. Thank you, Brian, and thank you everyone who submitted great questions. Unfortunately, we weren't able to get to four, but we can definitely reach out and answer those questions through email. Next month, we have our continued disability coverage, June 9th, with Kathy Bilodeau. So we hope to see you there. Thank you, everyone.
Great. Thank you, everybody. Have a good day.